Bollinger Bands can be applied to all financial markets, including equities, Forex, commodities, and futures. Bollinger Bands can be used in most time frames, from the very short period to hourly, daily, weekly, or monthly, but is one of the few indicators that adjust very well for our type of trading. Now, as I mentioned, you're trading CFDs with LVXO. A CFD, most CFDs or most traders close their contract in a couple hours the same day. But a CFD can stay open night after night after night after night after night. There's nothing you have to do. You can close it when you want to close it. But most trades are made within the same day. And we're looking at relatively quick market movements. And Bollinger Bands adjust very quickly to tell you what the current market's doing in the short term. Now, Bollinger Bands answers an important question. Are prices at the moment high or low? If prices are high, they're near the upper band. If prices are low, they're near the lower band. And that bit of information can be incredibly valuable, especially if you combine it with other tools, such as other indicators for confirmation. Now, a lot of people ask me, how do you combine Bollinger Bands with other indicators? If you hold on to the end of the class, what I've done is I've put together a little presentation showing you how to combine Bollinger Bands with MACD and RSI to make trading decisions or to understand what the market is trying to tell you. Now, Bollinger Bands are a technical analysis tool. Specifically, they are a type of trading band or envelope. Trading bands or envelopes serve the same purpose. They provide relative definition of high and low that can be used in a rigorous trading approach, in pattern recognition, and much more. Bands are usually thought as employing a certain measure of central tendency as a base, such as a moving average. So before I let you get you all confused with the jargon, let's go over to a live chart and I'll show you Bollinger Bands on your charts. Okay, so we're looking at a live chart. This is my teaching chart. It hasn't been picked to give you any trading advice. It hasn't been picked for a recommendation. I teach all classes using the same chart. Now, this is a live chart. Now, personally, all of my charts always have support and resistance already drawn on my charts. I think they are the most important tool anybody can have and anybody could want. And once you've drawn them on your charts, whenever price moves back to that zone, so do those old support and resistance lines. Now, me, I color code mine. I built a whole key that I know, not for you to know, that I know, because this is my personal color coding system. But if you see the dashed lines and the dark lines and the green lines and the thin red lines and the orange lines, they all tell me something. They tell me how important that price was in the past. It tells me how long that price, how many times in the past that price has been viable. It tells me whether it's been a major support zone or a minor support zone. So I use all of those for bits of pieces of information. Now, as I said, Bollinger Bands starts with a central line. And Bollinger Band starts off using a 20-period moving average. And that is the orange line right here on your charts. And actually, let me make it a little bit darker so you can see it better. And that is the orange line on your chart. That is simply a moving average, nothing more than that. Now, here's where Bollinger Bands gets a little complicated. We'll talk about it tonight. You don't have to memorize it. You don't ever have to calculate it, but you should understand it. Bollinger Band then takes that moving average and uses that moving average as the basis for building an upper band and a lower band. And the calculation for that upper band and lower band are called standard deviation. Standard deviation is a standard statistical calculation. It wasn't developed for the Forex market. It's not a financial calculation. It's used all the time in statistical analysis. So this blue band, which I just put on the charts above and below, they're both, Bollinger Band uses a 2 times standard deviation above and a 2 times standard deviation below. So it's using a +2 and a -2. So the lines above and below are mathematical calculations of the moving average of that price using 2 standard deviations. And it creates this envelope around price. Now, this envelope around price comes out in all different shapes and sizes. Sometimes it looks like an alien. Sometimes they look like snakes. Sometimes they look like, God knows what. They look like squigglies. The only thing that's important about the shape of this band is the width of the bands. The wider the band, and that's between the top of the standard deviation and the bottom of the standard deviation, the wider it is, the more volatile the market. The narrower it is the less volatility in the markets. Okay, but that's only thing we have to understand about the shape of the Bollinger Band. Now, there's a lot of other stuff that uses the upper band and the lower band. But just when we casually look at the shape, wherever we see this wide band, we know the markets are very volatile. When we see narrow bands, we know there's very little volatility in there. As the markets get narrower and narrower, we know the markets are very, very sideways at the moment. There's something called the Bollinger Band squeeze, which is a trading strategy which looks at for when the price gets very narrow and continues to be narrow. And what we're doing is we're looking for price to get squeezed in the center. Now, we don't know whether price is going to jump out this way or jump out that way, but we know sooner or later volatility will enter the markets and price will react. But before we can do anything, we have to learn to understand what the standard deviation is. So let's go back to my PowerPoint, and I'm going to explain it to you. We're only going to do it once. Like I said, you'll never have to do the calculations, but you need to understand what they come from. So, standard deviation. Interesting, in the real world, no statistician would ever calculate standard deviation by hand. The calculations involved are somewhat complex, and the risk of making a mistake is high. Also, calculating by hand is slow, very slow. Therefore, statisticians rely on spreadsheets and computer programs to crunch their numbers. Same thing with us. You'll never have to do any calculations. Now, standard deviation is a measure of the dispersion of a set of data from its mean. Boy, that's a mouthful. Wait till we get to the next one, but I'll explain it to you in a second. It is calculated by the square root of the variance by determining the variation between each data point relative to the mean. If the data points are further from the mean, there's a higher deviation within that set of data. Now, I have my master's degree in finance. I have an undergraduate degree in mathematics. This is even confusing to me in this terminology. But let's make it a little bit easier. Standard deviation is a measure of the dispersion, okay, of a set of data. What set of data are we using? Well, when we're trading in finance or Forex or CFDs, the only piece of information we have available to us is the open, the high, the low, and the close. So let's put that together. Standard deviation is the measure of the difference between the open, the high, the low, and the close from its mean. What's another word for mean? From its average. So standard deviation is the measure of the dispersion of the open, the high, the low, and the close from its moving average. It is calculated as the square root of the variance by determining the variation between each data point relative to the mean. So we can calculate how far the open was from the moving average, how far the close was from the moving average, how far the high was from the moving average, how far the close was from the moving average, and then put them together into a formula to get the variation or the difference between each one of those, and then take a square root of that. What do we have? Okay, we have standard deviation is a measure of the difference between the open, the high, the low, and the close of its average. It is calculated by the square root of determining the difference between the open, the high, the low, and the close relative to the moving average. Now, wouldn't it be important to you if you realize that the data points are further from the average, there's a higher deviation within that set? So in other words, if the open, the high, the difference between that moving average and the open, the high, the low, and the close were farther from that mean, that would tell you something important. It's going to tell you that that price is moving up, and it's moving up with a distinction. It's moving because when you see that the open is farther from the moving average, and even the close was farther from the moving average, the high was away from the moving, and the bigger the variance is. So in other words, if the open was way far or just a little bit above the moving average, and the close was way far from the moving average, and it hit a high way up away of moving average, the low was still above that moving average, that would tell you something about what price is trying to tell you. So that's what standard deviation is. In finance, standard deviation is a statistical measure. When applied to the annual rate of return of investment, it sheds light on historical volatility of that investment. The greater the standard deviation of a security, the greater the variance between each price and the mean, indicating a larger price range. For example, a volatile stock has a higher standard deviation, while the deviation of a stable blue chip stock is usually rather low. So in its simplest form, the mean is simply the average of all data points in each set. The average, the moving average. In investing, for example, you might want to know the mean closing price for the last 20 days or periods, which is your 20-period moving average. And by default, Bollinger Bands is set at 2. Now, the thing about, let me tell you a little bit about Bollinger Bands. John Bollinger, who developed Bollinger Bands, is still very active in the markets. And he actually operates the Bollinger Bands website, where you can go right to the horse's mouth and learn all about Bollinger Bands. Now, when he did his calculations many years ago, and all the years he's been checking it over and over again, he's always used a 2.0 standard deviation. 2 standard deviations above, 2 standard deviations below. So in other words, he took whatever that deviation was from that formula that we talked about and multiplied it times 2. Now, there are some gurus out there who tell you to use a 2.5. There's some that tell you to use a 1.75. You can adjust them, but you then have to check them. You'd have to understand what their effects are on the marketplace. So Bollinger Bands is based on a middle band, which is usually a 20-period moving average. The upper band by default is set at 2 standard deviations. The lower band is minus 2 standard deviations. So there we go. Let's translate it. Lower band, upper band, middle band. Okay, and now we know how to put it on our charts. We click that little button that says Bollinger Bands, click on it, and it's dropped on our charts. Now, Bollinger Bands provides us 3 ways to use it for our analysis. there is pattern recognition. Bollinger Bands makes what we call M's and W's. To be honest with you, that works very well in the stock market and slow moving markets. For CFD trading and fast moving markets, it takes too long to develop. It's like trying to use a head and shoulders pattern. You know, when you got to factor in all of those time periods to just see that head and shoulders, and by the time it generates the right shoulder and does everything, it's too long. It also gives us reversal signals. It helps us identify when the trend is in trouble. And this is crucial. And then it also gives us trend analysis. It helps us detect whether we're looking at a continuation or a conclusion, a retracement or a reversal. So there are many ways to use Bollinger Bands, but it's important to note that when the price touches the upper band, that doesn't automatically mean sell. Similarly, if the price touches the lower band, that doesn't automatically mean buy. In fact, take it from John Bollinger himself, who says there's absolutely nothing about a tag of a band that in or of itself is a signal. So let's go back over to my chart. So we have, actually, let me make them darker also. So when we talk about a tag, it's when price touches the upper or the lower band. We also have breakouts. Breakouts don't tell us anything, and tags of the band don't tell us anything. What we have here is, on the left, we have something we call walking the bands. When price is moving down, price should stay steadily near the lower band and walk down that edge of the band. Not touching it, not breaking through it, but you can see it walking down. Walking down, walking up. Okay. Now, what becomes crucially important is price should always be trying to touch that band. When price tries to touch that band and gets rejected, we know something has happened. Here we see price moving up the band. It actually even breaks out. It's not very important at this point, but here it falls back in the band and then moves up and tries to go higher than it was, and it gets completely rejected. Well, that's telling us at this point that that trend is in trouble. Not telling you to do anything yet. This is one of the few indicators that moving averages is critically important. Price doesn't confirm anything until it breaks the moving average. When you have price moving up, in and out, see here, it didn't come near the moving average. Pushes up, it gets rejected, falls down. Now you can move back up and move back in alignment. It's not until it breaks that moving average that we're told that that trend is over and the price is now moving to a downtrend. Here we see weakness. We wouldn't be buying into this and we might be considered selling, but we're not making a decision yet. Here, we broke the band. We would have sold when it broke the band. Because even here, it moved back above the band and tried to walk, but it was a dead trend. So we have walking the bands, rejection, and then crossing the moving average. They are three ways that we use Bollinger Bands to interpret what price is trying to tell us. So over here, you can see I've dropped my bands on the chart, but we also use the Bollinger Bands. We can use this to see channel trading. We see support and resistance lines by the bands. So we can look at the bands and see the rejection from the resistance lines. Again, here we see price walking up those bands. And not until does it get the rejection from the outer band and then break the moving average. Now, keep in mind, Bollinger Bands does not give you price. Bollinger Bands doesn't tell you when price broke the moving average and that trend is over, or that we're moving in the downtrend, how long that downtrend or uptrend might last. It doesn't tell you how far it might go. It's only telling you the weakness or strength of the trend, or if the trend is going to reverse or continue. So it's giving you information. And that's why you need to combine Bollinger Bands with other pieces of information or other indicators to be able to read what it wants to tell you. So as I said earlier, I prepared this little presentation, this little video that I'm going to share with you now that will show you how I combined Bollinger Bands with MACD and RSI for a nice little trading system. So let me share that with you, and then we'll come back and talk about it in a second.
Indicator 1, RSI. The relative strength index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages, which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages, and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market, and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of their time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4, Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5, confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the super trend indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the super trend indicator to change red here before taking the short trade. So now we have the confluence of 4 indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the super trend turning back to red.
Now, keep in mind that one of the most important words, or two of the most important words you can remember, are confluence and multicollinearity. Confluence means you're using indicators, indicators that use different parts of the market or different mathematical calculations to give you different pieces of information. Multicollinearity is when you're using multiple indicators that give you the both things. Like using RSI and stochastics is very redundant. They both use the same calculations. They both do pretty much the same thing. And they're both going to tell you the same thing at the same time. So if you use 4 indicators, they're all working like that, they all told you to sell, you'd sell. But when the markets may not be telling you to sell, but when you use different indicators that give you different pieces of information using different calculations, or one's a speedometer, one's a momentum indicator, one's a trend indicator, one's a volume or volatility indicator, and all of them are giving you the same piece of information, then you have a good, solid system. So remember, combining Bollinger Bands with RSI gives you a perfect match. They are like sisters made to go together. And I mentioned about walking the bands. Walking the bands is a great trading system. Bollinger Bands can also indicate the ends of strong trends. Strong trends cause an expansion in volatility that will cause the bands to initially move apart, meaning the lower band will move down opposite the trend. When a trend begins to wane, the lower band in the uptrend will move back up, which means that the signal, or might be a signal that the move might be over. Now, keep in mind, volatility tends to be mean reverting. Periods of low volatility are generally followed by high volatility and vice versa. And that's where we get the Bollinger Band squeeze that I mentioned to you before. So as you can see, Bollinger Bands can be useful by themselves, but remember that they can be combined with other indicators. Since they are a pure price indicator, you might consider combining them with a volume indicator, a trend indicator, a momentum indicator for more depth and insight. Ultimately, there's no indicator that guarantees you always get in at the bottom or out at the top. However, Bollinger Bands, especially when paired with other indicators, such as chart pattern recognition tools, can help you make better trading decisions because there's a preciseness using Bollinger Bands. Bollinger Bands are a great indicator to use in any market. When you combine these indicators with RSI, MACD, it should give you high probability trades. So thank you very much for joining us tonight. We'll talk to you again real soon. And if you have any questions, please feel free to contact us. And thank you for being part of the Alvexo family.